This episode is intended for informational purposes only. Neither Saunders Real Estate nor our featured guests guarantee the sufficiency of the content in this episode or that it complies with current law. The content within this episode is not suitable for legal advice or legal services or tax advice or tax services, and you should not rely on this information for any legal purpose without consulting a licensed lawyer or tax professional. Alderman is an associate attorney with Dean Mead law firm who specializes in land development, trust and estate litigation, and tax law issues in Florida. In today's episode, Austin and I discuss the impact of the recent election on tax policy, specific tax provisions impacting real estate and agriculture, the Corporate Transparency Act, and other tax-related topics that could significantly impact businesses and investors going into the new year. I hope you enjoy.
In Our Expert Opinion podcast is brought to you by Saunders Real Estate, a full-service land and commercial brokerage helping clients make bold and informed investment decisions since 1996.
Welcome back, everybody, for another edition of In Our Expert Opinion podcast. My name's Tyler Davis. Today, I'm joined with Austin Alderman, who's an associate attorney with Dean Mead law firm here in Florida. And today, we're going to talk about everybody's favorite topic, which is taxes. And we're going to keep this lighthearted, fun, energetic. Yes, we can have a fun conversation about taxes. So
I don't know that tax and fun necessarily belong in the same sentence, but we can try.
We're going to give it our best effort today, that's for sure. So Austin, welcome. Happy to have you here. Would you like to give everybody a brief background on yourself and your firm?
Well, sure. Dean Mead, we're a mid-sized firm here in the state of Florida. We have offices across the state. We specialize in tax. That's our background. It's what we do. And we like to help clients in unique scenarios. A lot of the agricultural clients, a lot of the clients with unique businesses. And we have the expertise and the knowledge to help them get where they need to go. For example, myself, I'm an 8th generation Floridian. I come from a family of cattle ranchers. So that's my background. I know what it means to work with dirt. And I know what comes with that and what you need to do to manage that.
You don't always find lawyers that are used to working on the farm. Those are few and far between.
Usually I like to show up in the office in my cowboy boots, remind myself a little bit of what I like to do outside the office. But I went to University of Florida for law school, graduated from there in 2019 with my JD, and then decided to stick around for another year. Said, "Oh, school's so much fun. Let me do that. Right. Let me do that for a little bit longer." Got my master's degree in tax law, called an LLM for lawyers, but. So my specialty's in tax, but my heart's in agriculture. So I like to combine the two and help out our clients that come from that agricultural background and figure out what they need to do to be most efficient with their taxes.
I love that. And my background, for those on the call who aren't familiar, worked in public accounting for several years, had my CPA license, still have it, I guess, don't really practice it. Got my master's in tax accounting from the University of Alabama. I'm jokingly a recovering accountant. I don't practice it anymore, but know enough to kind of be dangerous a little bit and hope that conveys today. But Austin's the real expert here, and we're going to give him, he's going to have a lot of chances to provide insights on where we're at from a tax policy standpoint. Obviously, recent election has a big impact on that. And just kind of setting the stage, we looked at Trump's first presidency, the impact of taxes being a big ticket item for him with the passing of the Tax Cuts and Jobs Act in late 2017. That was really the first big initiative, it seems like, that he took on. And just setting the stage, a lot of those policies will sunset either at the end of this year or next year. And so I think coming out of the election, looking at Republican control in the House and the Senate, just big picture, we'll kind of start the conversation out. It seems like logically that taxes will be one of the first things that this administration addresses once again.
No, I certainly think so. Trump's made it a key point on the campaign trail to talk about taxes, and he's made the Tax Cut and Jobs Act his signature bill of his first term. So he's going to want to try to maintain the terms that he set out in that original bill. Obviously, throughout the election, we had two very different views on the tax future of the country. And I think it's safe to say that at least with the full Republican control, you're not going to see an increase in taxes pass through the Congress.
Right.
Whether they can actually get an extension of the Tax Cut and Jobs Act done on the narrow majorities that they have sort of remains to be seen. But Trump has made it clear for himself that that's a key point. And as long as he can keep the party in check, I would expect there to be something done before the end of 2025.
And you think that's something, we talked about it. I think Trump wants an early win, like an early W on the scoreboard. And it seems like, given that there's a time sensitive matter to this, that it's going to be a priority.
I imagine it would be. I think probably the moment he's inaugurated, this is going to be a key point for him. Obviously, he kind of knows what he's getting himself into this time. This is not an inexperienced Donald Trump. This is Donald Trump who has been president for one term. So he has learned the inner workings of how being president's going to work. Whether he applies those lessons remains to be seen. But in theory, he would know how to attack what he wants his agenda to be from day one, and can theoretically try to push that as early as possible.
Right. And, you know, I think Trump's background as a real estate professional also lends itself to some good conversation and good policies in regards to what we're going to talk about today, which is an update on U.S. tax policy with somewhat of a real estate emphasis, because that's what our firm does. That's what y'all's firm does a lot of. And so let's just kind of look at where we're at now. So Trump has obviously been reelected, or elected, I guess, for the second time. The Republicans have a very slim majority in the House and a little bit stronger of a majority in the Senate. I believe 53 to 47 in the Senate. The House is somewhat tight, within five or six.
And some of those are going to get lost to cabinet positions. So it looks like it's going to be even slimmer by the time Trump actually is in office.
Right. And, you know, I think looking back to 17, where we were at when they passed the Tax Cuts and Jobs Act, it was a different world we were in then. It was pre-COVID. It was still lower interest rates. It seemed like taxes were an obvious thing that he wanted to hang his hat on, make it a legacy item, as you mentioned, and we expect that to happen again here. Do you think there's even more? Do you think he'll try to take taxes further than he did the first time in terms of the aggressiveness of cuts, wanting to? A big part of what he did in 17 was try to get the economy going again, to get businesses to invest money, to get people to spend money on assets and projects and real estate. Do you think, because of where we're at from an interest rate environment right now, which is high interest rates, Fed obviously maybe making cuts, but he might have limited impact on the interest rate front? Do you think he's going to be more aggressive about trying to use taxes and tax cuts as an incentive to get things going again within the real estate sector?
I think he's already kind of indicated that is the plan. Yeah, he has Vivek Ramaswamy and Elon Musk working on their Doge project, which they've been pretty clear is intended to offset these tax cuts that Trump's looking to do. So in his mind, he's thinking, okay, I have to cut somewhere, otherwise we're just going to run up the bill.
We can't keep running up the deficit,
exactly.
So we got to cut.
So he's looking for places
somewhere
to cut spending, I think, with the idea of either making the Tax Cut and Jobs Act permanent or bringing about other tax cuts based on his new agenda. And as we discussed previously, the Fed has shown that they're not going to bend the knee to Trump. They're going to try to maintain their independence to the extent that they can. Mm-hmm. So I don't expect him to look to them to try to combat what he sees as inflationary points or issues through trying to negotiate or trying to manipulate interest rates. He's probably going to try to generate business or economic development through tax policy. That's what I would expect from this Trump administration.
Yeah, and I think so too. And it remains to be seen the ability to do that. But I think we all anticipate something to be done early first quarter, second quarter this next year. So let's transition a little bit into some of the specific provisions that impact real estate owners, real estate investors, the ag world as well. Some of these sunset at the end of this year or next year. We look to see extensions or making those permanent. So let's just kind of get into it. So one of the big ones that impacts small business owners of many types is 199 Cap A. So the QBI pass-through deduction. So, you know, kind of big picture for me, I've always tried to interpret this one as when Trump reduced the corporate tax rate down in 2017, everybody looked, okay, what's going to be the offset to pass-through entities? And it was 199 Cap A, this 20% deduction. So that is currently set to sunset at the end of next year, I believe, December 31st, 25. Kind of give us your thoughts on that one. Feel like it's something they're going to try to make permanent moving forward?
It seems like, based on the agenda they've put out, it probably is. There have been some discussion, the bonus depreciation under 199 Cap A, there's been some discussion about raising that back up to 100%. Part of the Tax Cut and Jobs Act was a slow sunset where they cut off 20% a year from, I think it was 2020 up until it finally ran out in 25. Well, there have been some discussions about bumping it back up to 100% and making it retroactive back to when the phase out started. So the
And that would be the most aggressive.
That would be the most aggressive response
Which
possible.
a lot of us in the real estate world would love to see that.
And we'd love to see it too, to help our clients with their planning. But I think I would agree that's probably the most aggressive response. And whether that's something that they can get done, well, it remains to be seen, because they're gonna have to cut somewhere. Like you said, there's gonna have to be an offset. So that's what they've said on the campaign trail. That's what they've said they'd like to do. Whether they can pull it off, that's the question. But the Trump administration has indicated that is what they would like to do. So it's certainly possible that by the end of 2025, we could see that incorporated in some sort of bill.
Yeah, and I think, on the bonus depreciation world, I think, given a little bit of background, so, there's several different ways to depreciate assets, and we're not going to go into all of the given details, but at a high level, the Trump administration basically created in 2017 100% expensing of a lot of different types of investment, including several real estate activities, as long as the cost allocation of those assets was 15-year property or less. So that accelerated a lot of costs on acquisitions, redevelopment, property improvements into shorter term life periods, but then also moved a lot of that up into the first year that an asset was placed in service or purchased, usually is when that occurs. And then that 100% expensing was phased out by 20% that you mentioned over the next five years. And so now we're getting to the lower end of that, where the impact is much lower. And so given that rates are higher, I feel like that's an obvious one where they might say, okay, if we could at least increase the amount of tax depreciation the first year an asset or real estate is purchased, to make some of these numbers and returns look better to compensate the high interest rate environment we're in, that seems like one that I hope and think that they will be very aggressive in trying to pursue.
And I think you're probably right. I think that they may look at it as a way they can say to their constituents, they can say, well, okay, we can't get the interest rates down now, but we can cut you a tax break.
Right.
We can get you this deduction. You can deduct 100%. I know that it's going to be hard. You have to go out. You have to get a loan at 7, 8, 9% on this piece of equipment or this improvement, whatever it may be. But you get a little tax break. So that's, like you said, it'd be an easy win for the Trump administration to just come in and say, we're gonna extend this. We're gonna make it retroactive. That's probably where they may run into a little bit more pushback, is say, all right, we're gonna be really aggressive here, make this retroactive to anybody that's taking it at the 80%, the 60%. Well, now you got to go back and amend and make it 100.
I think it'd be fascinating if they were to pull the trigger on that, because people would have to go back and amend these tax returns in the past, which would be several years in the past. So to me, that would be a really interesting case study if they could get it done on how that would roll out, how you could go back and do it. But it seems like, especially to generate a little bit more liquidity for some of these real estate firms, real estate investors, if you could amend your prior year tax returns, get a refund back or a credit moving forward, to me, that would be a way to say, okay, we're going to help you prospectively, but also if we go retroactively, here's a way that you can get a little bit more capital in your pocket to deploy into new deals, or maybe offset some of the higher soft costs on a lot of these projects.
No, I agree. I think that it's something that firms have to look at as essentially they're going back and changing their books for prior years.
Correct,
saying, okay, well, maybe we had a little bit better year 2 years ago than we thought we did, because, well, Trump's come along and he's changed the tax laws. And that's something that could potentially, like you said, increase their ability to invest, increase their ability to purchase further improvements, different things that they may need to do. Well, now they have a little bit of liquid cash that they could do it with.
Right. And I think, again, the majority in the Senate is strong. The House is a little bit tighter. So I feel like, just big picture, the more he pushes, he's going to have to cave on some other items to accommodate and get people's support.
Well, and I think if you just look at his broader agenda, I think there's some easy items he probably could cave on. We're not talking about a president who's looking to be reelected. So some of these campaign promises he's made, he doesn't really have to worry about the effect of what happens if I don't deliver on them. And some of his bigger promises, you could say some of the no taxes on tips, the no taxes on Social Security, things that are a little bit
out there
are probably an easier place for him to say, okay, fine, I'll back off on no taxes on tips if you give me this.
Right.
And considering Trump's background in real estate and how he thinks of business and investment, he's probably more likely to try to push towards the business investment tax incentives than he is the, okay, no taxes on tips.
Right.
And I think that that's probably where we'll see some give and take, is in some of those bigger promises that the Trump campaign made that he's not likely going to deliver.
To me, it's always hard, and I get this question a lot every presidential cycle, I feel like, from people at our firm and outside of our firm, just, given our background, and you probably get it too, Austin, but it's always hard to decipher between what's red meat for a party in terms of getting elected. From a tax policy standpoint, you see one party, one candidate really push extreme tax agendas on one side, and then the other party does the same thing to their party. And so everybody always, there's a little bit of hysteria a little bit when things are brought out in the news and media in terms of this is my plan. What's actually possible in terms of getting things passed is a whole nother story, and it always winds up being somewhere in the middle.
Yeah, and obviously Trump is an outlier figure. He's not your standard politician. He's hard to kind of pin down on what he's really going to do, but we do know what the Republican Party typically does throughout its history,
right.
And typically they're very business friendly. So I would expect them to look towards the business aspects and what they can do to incentivize business and economic growth, and maybe cast aside some of the more populist ideas of Trump's campaign promises.
That's right. And I think, when we look at some of these other items that have always been seemingly, quote unquote, on the chopping block from a tax standpoint, one of them in our industry that people always bring up is 1031 exchanges. And so, those have been around for 100 years. However, they always seem to be the first thing that a party will try to go after to say, we need to get rid of this. From kind of going down our list of items that impact the tax world, I think 1031 exchanges here to stay. Trump's probably going to do nothing except maybe, even if he's going to do anything to them, probably likely expand the ability to do them.
Well, I think that's an interesting point, because that's one of the things in the Tax Cut and Jobs Act that arguably was anti-business, was that Trump limited 1031 exchanges to strictly real estate.
That's a good point.
We did have the prior ability, you could 1031 on a vehicle or
personal property,
things like that.
Real property.
And the Tax Cut and Jobs Act limited it to just real estate. And that was one of the things where it was a give to get some of these other things, was they made it so that it only applied to real estate. And that would sunset with the Tax Cut and Jobs Act. And if they do renew it, it's likely that probably stays the same.
So that would revert back to where you could do personal property.
Exactly. If it was allowed to sunset.
Okay, understood.
But
Gotcha.
I think it's most likely that probably stays in any extension, because it was a place that they gave that they weren't, they were trying to find some extra funds to make up for the different tax cuts. And I think in their mind, that was a reasonable place to give. So they feel like I feel like that's probably a place that would stay regardless of what Trump does.
Right.
Yeah, I know in our prior discussions, another topic we had talked about was state and local taxes, which for us here in Florida, we're pretty lucky that that's not a huge issue. We're not paying big income taxes. We do have property taxes, of course, but we're not paying that on personal property generally. So it's not as big of an issue here, but nationwide, it has been an issue.
Can you give the listeners just a high-level background on what changed in 17 and then what could change now as we look at, a give and a take scenario?
Sure. On a high level, prior to the Tax Cut and Jobs Act, a person who was, they didn't just take the standard deduction, they were itemizing their deductions. They could deduct an unlimited amount of their state and local taxes from their tax returns.
Which in some of these
states would be a personal, it could be a personal income tax, it would be a property tax, personal property tax, and I'm not familiar with it.
So on and so forth.
So on and so forth in various different states. So it was a big deduction potentially for these people in these high tax states.
Especially city taxes too.
Especially you get city taxes, like and so it really adds up pretty quick. Well, when the Tax Cut and Jobs Act was put into place, they put a limit of $10,000 on the state and local tax deduction, which for some of these states where these things happen, that adds up. That's gone very quick.
And has been probably, I don't have data to support this, but likely good for Florida, and that people want to try to spend more time in Florida.
I haven't done the
non-tax,
haven't done the research to see how, but just anecdotally from speaking with people, that's been a big issue for people that have moved to Florida, has been that, my taxes in California or New York have increased. I can't afford to keep paying them. I don't get
the tax
I don't get to
deduction.
deduct them on my federal taxes. Well, at least if I go to Florida, I don't have to pay as much in state and local taxes. So that has been a key point for some people. But the Trump campaign has talked about addressing that. They've said that that was maybe a mistake in the
aggressive.
2017 law. They felt like, okay, I've seen some discussions of eliminating the limit, which I think would be the most aggressive response, because obviously this was a give to try to generate revenue from places where they had cut income.
And given that a lot of those states are probably more Democrat heavy, it seems like to get some of this done in the House in particular, there's likely going to have to be a little bit of a give back on the SALT limit to make amends for some of these other things and to correct some of what went wrong.
And I think that could potentially bring over some Democrats in states that maybe feel like they could be vulnerable, that maybe they had a pretty tight scare in the most recent election where they felt like, oh man, maybe in 2026 I might lose my reelection on a midterm type election. So they may say, maybe if I work with Trump, but I get this state and local tax thing done, I can go back and tell my constituents, hey, I got them to get rid of the limit on the state and local tax deduction.
Right.
I've seen some out of the Trump campaign talk about raising the limit. It's talking about maybe 20,000 rather than 10,000. So it doesn't seem like there's a firm decision within the incoming administration as to how they want to tackle it. But it is a key point that's on their radar that they want to address.
And some of where it lands probably depends on how aggressive they are on other things that they want to push as part of the give and the take.
Exactly. I'm sure that within the incoming administration, they probably have a list ranking these different points of,
That's right.
What has to stay, where can I give, and what can I cut, and where that falls. I don't think anybody knows right now, but it does seem to be a key point. Trump himself has talked about it. Some of his key advisors have talked about it. So just kind of reading the tea leaves, it seems like they view it as a key point for them to address, that it was a mistake, I think they think, in the 2017
And
Act.
I think that some of the comments they've made make them, like you said, realize maybe we need to focus on fixing this, or at least making some concessions in terms of the aggressiveness of what they proposed.
Yeah, I think that they feel like they've learned from the first go round, and they feel like, okay, maybe there's things we could do that would make this a little bit better, that would make this a little less likely to raise the deficit, things that they think they could help or improve what they've done. Whether it actually pans out that way, of course, remains to be seen, but there seems to be a willingness to change what they've done, with the idea of nothing's perfect and everything can be made better some way or another.
Right. So a couple other things I want to bring up, just thinking about it from our industry and the questions that I get, oftentimes it's around bonus depreciation, 1031 exchanges, capital gains, and estate taxes. Mm-hmm. From a capital gains standpoint, I don't believe the TCJA made any major changes. Is that correct?
No, I mean, throughout the election, obviously the big point of the capital gains question came more from Kamala Harris and her campaign. Mm-hmm.
Unrealized gains.
Exactly. Looking to tax unrealized capital gains. And obviously that's something that is not on Trump's radar whatsoever. That's not, essentially that idea died with his election. So I wouldn't expect them to do anything to affect capital gains negatively. Right. Certainly they may try to do something to relieve capital gains taxes, right. But I don't expect much of a change, if anything, to the capital gains.
And that's always been, let's think back to like this summer when we had deals going under contract, things like that. There was a big push from several people and several clients of ours to try to get things closed this year because of uncertainty around where the election would fall, and at least knowing a certainty of what capital gains are now, uncertainty of what they could have been if Vice President Harris had gotten elected. And so, now that things went the other way, I think there's almost, like you mentioned, maybe more of a sense of optimism and at least confidence again that capital gains aren't going to change in a negative way. If anything, it'd change somewhat in a positive way.
Yeah, I think that's the general feeling. That's even with ourselves. That's kind of how our thoughts on it are. Is that, well, I don't expect anything negative to transpire here. Is that it's going to be We know what Trump's about when it comes to taxes, and it's not raising them.
Right.
So at least to the extent that he can go out and say, I did not raise capital gains taxes, he's going to try to do that.
Correct.
There may be some inadvertent side effect, how these things go, but I don't foresee anything negative for capital gains out of the Trump administration.
Another big one that impacts real estate, as I mentioned a second ago, is state taxes. That includes not just the exemption, but the step up in basis at death to fair market value, all the implications of estate taxes. And just kind of for background for the audience, a lot of you probably know this, but when the Tax Cuts and Jobs Act was passed in 2017, it in essence doubled the estate tax exemption. That continual increase has been tied to inflation numbers. And so now Austin can give us the exact numbers, I'm sure, on what the estate tax exemption is per person and per married couple. But right now, as of the end of next year, I believe, the end of 25, that the increase from the TCJA is set to go back to what it was pre-Tax Cuts and Jobs Act, which would, in essence, be cutting the estate tax exemption in half.
Correct. I think for next year, adjusted for inflation, the number comes somewhere close to about 14 million for an individual, and it'd be close to 28 million for a married couple. If the sunset were allowed to happen and it reverted back to the prior calculation of the exemption, adjusted for inflation, I think the number should come out to somewhere around 8 million per individual. So it'd be 16 million for a married couple. So you are looking at essentially a half, having
close enough,
close enough to
for government work.
Exactly, for government work for sure. That's close enough. So we're cutting. You would be cutting the exemption essentially in half, and that is going to be something that the Trump administration is looking to make permanent. The enlargement of the estate tax exemption, they're going to want to make that where it's not going to sunset. They're going to want to make that a permanent thing in the tax code, and they have said as much. And that's part of their agenda with pushing forward the Tax Cut and Jobs Act, is to make the enlargement of the estate tax exemption permanent. So I don't expect any negative action out of the Trump administration. The question really is just, can they get something done in time for the sunset in 2025?
Correct. And I think that's where a lot of our clients and people we work with are landing, who, there's been a lot of appreciation in assets and net worth over the last 5 or 10 years, even here in the U.S., especially in the real estate sector in Florida. And so there's a lot of people now who are in that position of, hey, we actually need to start trying to do some estate tax planning because we might have an issue because things have gone up so much. So I think where a lot of our clients are landing is, hey, we need to get plans done by the end of next year. However, it would be nice if we didn't have the rush and the fixed deadline of having to get it all done because things change and decisions are made and things like that. So I think a lot of people hope that does become permanent, and it would help from a planning standpoint, at least the earlier the tax reform changes are addressed.
Yeah, I think that I kind of in line with what you're hearing from your clients. I would say if you're looking to do tax planning, try to do it as early in the year as possible, because if something doesn't happen, there's going to be a rush at the end of the year to get these tax plans done. If we hit July, August, and there doesn't appear to be any momentum towards extending the Tax Cut and Jobs Act, it's probably time to really start planning heavily for the idea of it not getting extended.
Right.
I think that by then we'll have an indicator of what they're going to do. I would expect, sort of going back to the beginning of this conversation, that it's going to be one of those key items for the very beginning of the Trump administration.
Agreed.
I mean, you can look back to his first administration. That was his first big bill, was the Tax Cut and Jobs Act in 2017. He went into office in January of 2017, and one of his big focuses was taxes. And I think we're pretty much going to have a deja vu scenario here, where he's going to go into office in January of 2025, and he's going to want to do Tax Cut and Jobs Act Part 2. And that's going to be a big focus of his administration, while they have at least 2 years of their slim majority.
Right. So you heard it here first, people. If you need to do tax planning around estate taxes, you need to do that early in the year. Austin, if you know any good attorneys who can help with these kind of things,
it'd be good for the audience. At Dean Mead, we have a great number of attorneys that can help anybody with their estate planning. So of course, feel free to give us a call, and we'd be happy to help.
That's right. I do want to hit on a couple other topics fairly quickly as we look to wrap up here. corporate taxes. We reduced the corporate tax rate from 35% to what it was. What does that look like moving forward within tax reform? Is there anything related to repatriation of foreign earnings? We don't have to go super in depth, but any major overhaul changes we're looking at on the corporate side?
I think probably the biggest one is that there's been some discussion coming out of the Trump campaign and the transition team of, again, lowering the corporate tax rate. We went, like you said, we went from 35 to 20. There has been discussion amongst the transition team about lowering it to 15. So there's some serious discussion about, again, cutting the corporate tax rate. And I think that may be one of those more aggressive type asks, right. And whether they can get that done remains to be seen. But they're certainly looking at the idea of further corporate tax reform,
right?
And it is on their radar. They're not just going to let it lie with how the TCJA was. They're looking to do more.
Yeah, it'll be fascinating to see how some of this shakes out here. Hopefully, in the first quarter or two of the new year.
Hopefully, for sure.
The other thing I wanted to bring up, and this has been a big discussion point for everybody probably who's listening to this and has been impacted, which is a lot of people, is the Corporate Transparency Act. Can you kind of give us the background on that bill, that new rule, the requirements of it, and then also where things stand at the moment? There's been a lot of moving parts.
Yeah, there have been a lot of moving parts, and very recently there have been a lot of moving parts. I guess sort of to give a little bit of the background, this goes back to the first Trump administration.
And we're recording this on December 16th, by the way. So if people are listening in the future, you might want to check back in to see if there's any new updates.
This may change by the time we walk out of the studio today. But for now, this will be current as of the moment we speak. So the Corporate Transparency Act goes back to the original Trump administration. Trump actually vetoed the bill, but it was passed. The Congress overrode the veto and pushed it forward. And Trump has made it a point of his administration that he would like to overturn the Corporate Transparency Act. That's been a point of his. But there have been a number of cases being litigated regarding the Corporate Transparency Act and its constitutionality. There's been 2 or 3 cases out of various district courts that have found it to be constitutional, that have upheld it. The first case that found it unconstitutional came out of a district court in Alabama, which has been appealed to the 11th Circuit Court of Appeals, which covers Florida, Georgia, and Alabama. So once we have a ruling from them, we'll see a little bit how a higher court is feeling regarding the constitutionality of the bill, and would potentially affect Florida and Georgia and Alabama alone. Though most interestingly, there was recently a case that came out of the Northern District of Texas, where the judge in that case determined that the law was unconstitutional and has issued a nationwide injunction against the implementation of the Corporate Transparency Act. Obviously, we expect that the federal government's going to appeal that. They have indicated that is their intent. However, FinCEN, the organization that's responsible for maintaining the information reports that are filed under the Corporate Transparency Act, has indicated that as of right now, they are honoring the injunction and they're not requiring anybody to report.
Previously, the requirement date, there's several different ways you could be eligible,
Exactly.
but the main end date for existing businesses was the end of this year.
Yeah, January 1, 2025 was the due date for any pre-existing company. Companies that were formed during this year had 90 days from the date of their incorporation, formation, whatever type of entity it was.
Right.
So currently, if you formed a business right now, you would not be under any obligation to report, and existing businesses are not currently obligated to report. However, it's very likely that that injunction is stayed on appeal. There's the possibility that it's overturned. And despite the fact that FinCEN has said that due to the injunction, they're not currently due, they have not said that that would result in any tabling of the current due dates. So it's very possible that suddenly the injunction's overturned and they say everything's due right now.
Right now, yeah.
So
in some ways, it's still best if you are subject to this to maybe go ahead and file it. It does not take long for most people. I mean, it's complex if you have.
It is a little complex if you've not done it. Once you've done one, it's pretty easy to figure out what you need to do. They do offer you the ability to get a FinCEN ID number, which even speeds up the process more for someone that may have multiple entities. But as it stands right now, you don't technically have to, though it seems like the best practice would be to move towards the idea of it being required.
I filed all ours about 2 days before that injunction came into place. So I was trying to be a good law-abiding citizen here, even though, we can talk about the reasons for this bill and who should apply, but or who should be subject to it in terms of the purpose of it. But that's a whole nother conversation. But I did all these, probably 20 or 30 of them for various entities, and then 2 days later, the injunction happened. So I'm sure there's other people out there like me that it's okay.
You're not giving up any information the government doesn't already have.
That's right.
It's the same information they can get from your tax returns. And that's one of the big points of frustration with it is people say, how come you're making me do this? You're adding this extra cost
Especially
on
for
me.
small businesses that are
Exactly.
100% domestic, 100% U.S. citizen members or owners of it. It just seems like a big requirement.
Especially when you sit down and you look at the bill and these large companies are exempted from it. The ones that would
You would think the target would be the large multinational firms that have various money moving from different places.
When you sit down and think about it, you'd think, okay, that may be why you would want that. But obviously the government thinks that these small businesses are the way that foreign nationals are funneling money in and out and laundering their funds, different things. But essentially really kind of what everyone's feelings on it comes down to is that you already have this information. Why are you adding the extra cost of reporting this onto me when you over here could talk to you over here and get the same information from my tax returns, from my filings with the state, whatever it may be?
Right.
That information's there. How come you're putting the onus on me to give you the information when you already have all of it?
Yep, correct.
And that's the biggest frustration with it. So the reporting is not difficult. The form that the federal government's put out is pretty straight.
It's quite simple.
It's
actually.
quite simple, really. It's really a question of why more so than the actual difficulty of it. Right. So hopefully these injunctions will stand and we won't have to worry about it in the future.
Another fun thing to watch.
Oh yeah, just another. We promised fun, and this is just another fun thing to watch.
Within the tax world, it doesn't get more fun and interesting than in financial reporting world than everything going on now.
Yeah, no, in the legal world, nothing is more fun than a split amongst federal courts on what they think is constitutional or not. Because then you just sit giddy and you wait for the Supreme Court to give you an answer as to what's going to happen.
That's right.
And given the background of this Supreme Court, if they get one of these cases, we know that they tend to be pretty well in alignment with Donald Trump. Right. Well, he's anti-Corporate Transparency Act. If they get a bite at the apple, they may say that it's unconstitutional. So it's one of those stay tuned type things.
Get your popcorn ready.
Exactly.
So, Austin, I appreciate you coming in to talk to us today, and everything your firm does. Y'all's partnership with our firm on several fronts has been wonderful, and we really appreciate you coming in. Again, audience, it's going to be a fun year of taxes. I think there's a lot of moving parts to this that are going to come out in the next 2 quarters, we think. And so a lot of different impacts on your business, hopefully in a positive way. And we look forward to seeing how all this shakes out. Austin, thanks again.
Great. Thank you.
Thank you for listening to In Our Expert Opinion Real Estate Podcast. Don't forget to subscribe on your favorite podcast app so you never miss any of our upcoming episodes. For more on land and commercial real estate, please connect with us at saundersrealestate.com.